So we continue on the gold theme this week. Now, last week, our resources expert, James Cooper, shared his first-hand experience watching Barrick Gold's dramatic fall from grace in the last cycle. Today, he's back with part two of this fascinating story, how one company's disaster became another's golden opportunity, quite literally. Now, there's a brilliant lesson here about market timing too. While Barrick was desperately selling off Australian gold mines for pennies on the dollar, a small group of local entrepreneurs spotted something everyone else missed. For just $100 million, about $30 per ounce of gold, they picked up what would eventually become Northern Star, now Australia's largest gold producer. So, James, welcome.
Thanks, Woody. Good to be back again.
Yeah, let's start with something that really jumps out from your piece today, this stark contrast between Equinox's CEO, who sold at the peak with minimal corporate overhead, and Barrick's massive team, who got it completely wrong. What does this tell us about successfully reading market cycles?
Yeah, so what it tells us, it doesn't matter how many resources you have. So Barrick Gold back in 2011, this is when I was working for Equinox. Back then, Barrick Gold was the world's biggest gold miner, and it took over Equinox, which was really just a sort of mid-cap size copper producer and explorer. It had its head office in Perth, operations in Zambia. So you had one CEO who was sort of head of a sort of smallish size ASX company, and you have another CEO who's the head of a major gold corporation. And one is sort of perfectly aligned and understanding how the commodity cycle works. And obviously Barrick, who bought in the very peak of copper prices, just failed to recognize where the industry was moving, and really paid for that down the line, which we can speak about. It's really decimated the biggest gold miner.
Yeah. I mean, you had like we touched on last week. You had a unique perspective watching both Equinox's success and Barrick's unraveling from the inside. Yeah. What were the key differences that you observed in how these companies approached decision making? Did you have an insight into that?
Yeah, I think Equinox really saw things in terms of value. So it was developing projects sort of at the beginning of the cycle in the early 2000s. So was Barrick to a certain extent. Equinox is sort of probably more disciplined in capital investment. When I was working with Barrick, we were sort of undertaking, so after Barrick took over, we undertook what was actually the biggest resource drill out in Africa. So we drilled over 100,000 meters to develop the resource around Equinox's Luana mine. So this was a lot of spending, a lot of development happening really at the peak of the cycle. So again, I think we just saw Equinox, which was really much more had a lot more capital disciplinary, versus Barrick, who was really just throwing cash in both to get hold of Equinox, paying $7.2 billion at the very peak of copper prices, but then also splashing a lot of cash to then develop that project and try to justify the expense that it paid for it. So it was really a sort of a double-edged sword or mistake that it really fallen into. So it was an important lesson, and it was really just a microcosm of what the broader landscape, what was unraveling for Barrick, which we could also touch on as well.
I was going to say, you mentioned how most executives tend to buy when conditions are feverish and sell during the slowdowns. Is there a way to spot the executives who consistently buck the trend? Because that's got to be telling about what they're doing. And does that give you an edge or anything?
Yeah, absolutely. So if we just sort of take the last mining cycle as an example, so the peak, And this is when all the hubris was happening, all the mining execs really no better than investors, really just getting in at the peak of the market, following the news, and buying assets at sort of at huge premiums, which were then took on huge discounts after the sort of China and commodity prices started to fall away. So Barrick took a big hit on the Equinox acquisition. Yeah. And I think you can look at directors and projects which might have managers that have a tendency to recognize the commodity cycle and really sort of capitalize on cheaper prices. So a really good example was Northern Star. So its rise from a penny sort of dreadful stock, which we go into detail in the article, just a few cents. So a guy called Bill Beament and a couple of engineering mates. Bill Beament was a mining engineer, so he worked a lot in Kalgoorlie, the Eastern Goldfields in WA. So he understood the operations, and Barrick had developed a big presence in this area. But of course, in the panic when commodity prices started to fall, including gold, in sort of around 2014. Barrick panicked, so it sold off a lot of its global assets, and that included all of its Australian assets. And this is when, I guess, the counter-cyclical movers, the type of company directors that we really should be following as investors, started to move in and buy these assets at much cheaper prices. So Northern Star bought up Barrick's 3 Eastern Goldfields projects. I think you touched on the exact numbers. I think they purchased 3 mines for which equated to 3 million ounces of gold, and that was, I think, for about 100 million in cash. So I think about $30 an ounce. Although a lot of those ounces were sitting in the ground, it just represents the huge value by taking these counter-cyclical purchases. And I think this is, as an investor, you really want to be following these types of directors who understand the cycle. That was represented by Equinox, and when I was working for Equinox, they started to develop that project in the early 2000s, well before commodity prices really started to surge. So
it just shows the cliches, right, isn't it? You buy low and you sell high, but it's just very difficult to do. Find the people that are doing that and then copy them, basically follow them.
Absolutely. But one thing you can do, even though it can be hard in real time to understand where you are exactly in the cycle, you could look at projects and companies that were putting money into development projects maybe 5-6 years ago. And these projects are now coming online, production's increasing. So these are the types of companies you could really focus on. These are the counter-cyclical movers. So, definitely pays to have an eye on the commodity cycle.
Another interesting point that you raise is how academic credentials and titles don't necessarily translate to market timing ability. What qualities do you look for in management teams when evaluating a resources company? Is that part of your analysis, or is it something that you don't give too much credence to other than the charts and the fundamentals?
Well, from what I saw back in the last sort of boom to bust phase, it really didn't matter if you're a PhD of mining economics or if you're a CEO of of the world's biggest gold company, unless you didn't have an understanding or recognition of the commodity cycle. So how investment flows into markets at sort of peaks, and M&A activity tends to peak at market tops. Unless you sort of don't understand the sort of supply fundamentals driving the market and sort of try to ignore the hubris and the big headlines that take place, you should be buying low and selling high. And I don't think a lot of corporates or well qualified people in the industry actually follow through with that. So discipline is really important as an investor, and then just understanding the select few companies who do tend to follow the cycle and invest in their projects accordingly.
Final question for you, James. Looking at today's market, then, do you see any parallel situations where companies might be making similar mistakes to Barrick's 2011 decisions? And what lessons should investors take from that history? Is there any companies right now you're like, nah?
Yeah, I think we're definitely, it's still early, fairly early in the cycle. I think if we look at the last commodity cycle, we might be around 2005, so exactly 20 years ago. This was a time when there was a lot of bullish activity was starting to build. There was a little bit of M&A action. There was certainly a strong outlook for things like copper. Gold prices were doing well. We're seeing gold break into all-time highs today. I don't think there's any huge warning red flags yet. I think there's still a lot of value in the market. So I think really trying to capitalize on these projects. If you're looking at late stage development projects or early production, this is probably the key focus, I think, if you want to sort of capitalize on sort of more bullish movements over the next couple of years.
Cool. There you go. We'll leave it at there, James. Thanks for your time. Check out part 2 of James's piece. The first part was last week, the second part today. Links below, full articles on that link on our website. Enjoy it. Let us know what you think. And mining memo full-time from next week, isn't it, James?
That's right. Full-time next week. Monday,
Cool.
Wednesday, Friday.
All right. Thanks, buddy. Chat to you soon.
Thanks, mate. Cheers.